Welcome to the deep dive.
Hello.
Today we're jumping straight into something really foundational for, well, anyone thinking about investing their money.
Yeah, the core principles. And we're looking at them through a classic lens.
Right. The book, often called The Bible of Investing, Benjamin Graham and David Dodd's Security Analysis.
Exactly. Our source today is actually a summary of that incredibly influential work. It laid out ideas that, shaped value investing for decades.
And our mission today is pretty straightforward. Unpack those key insights from the summary for you.
We want to help you get a handle on the kind of thinking that guided legends like Warren Buffett.
Thinking that can really provide a clear path, even in today's, let's face it, often confusing market.
For sure. We'll look at what it really means to invest versus speculate. Why analyzing companies is so critical. How deep you need to go.
Okay.
Different strategies. And maybe the most crucial concept for protecting your capital. The margin of safety.
Okay, let's get into it. So the first big takeaway, and maybe the most fundamental one from our source,
is just how vital it is to do your homework before you invest. Specifically, fundamental analysis.
Absolutely. It sounds obvious now, maybe, but Graham was really pushing back against the norm back then. People were buying on tips, rumors.
Just chasing whatever was hot.
Exactly. He said, no, you must look at the actual business first.
Right. So fundamental analysis. It's basically about understanding the company's underlying health, its real worth.
Precisely. It's intrinsic value, not just the ticker price flashing on a screen.
And that's the core of value investing, which
Yeah.
Graham championed. Finding stocks the market is undervaluing.
Selling below their true worth. And you can't figure that worth out without digging into the fundamentals.
Okay.
The source uses a good hypothetical, like an AI software company. Let's call it XYZ Limited.
So how would you analyze XYZ? You start with the financials.
Yeah, you pore over the statements. What's revenue growth been like? The example suggests, say, a healthy 20% average over 5 years. That's promising.
But growth alone isn't everything, is it? Not at all. Are they actually making money on those sales? That's the profit margin.
Right.
If it's consistently around, say, 30%, like in the example, that tells you they run their business efficiently, profitably.
And cash flow. I imagine that's critical for a tech company.
Oh, absolutely vital. Cash flow is the actual money coming in and going out, not just accounting profit. Positive cash flow means they can fund R&D, crucial for AI reinvest, maybe make acquisitions.
Okay, so you look at the company's numbers. What else?
Bigger picture, industry trends.
Hmm.
Is the market growing? For AI, the answer is clearly yes. Huge demand for automation.
So you put it all together. Strong financials, good margins, cash flow, growing industry.
And based on that analysis, XYZ Limited looks like a potentially solid investment candidate because the fundamentals support its value.
Got it. The source also gives a real-world example, right? Mahindra and Mahindra in India.
Yeah, back in early 2020, remember the auto sector was already slowing down.
And then COVID hit. Panic.
Total panic. M&M's stock price tanked, hit something like 280 rupees by early April 2020.
Ouch.
But if you were an investor who had already done the fundamental analysis, looked at their assets, their long-term potential,
You saw something different.
you saw an opportunity, you trusted the underlying business was sound and would eventually recover.
And it did, providing great returns for those who focused on the fundamentals, not the fear.
Exactly. It just hammers home that point. You must do the analysis for long-term success. No shortcuts.
That focus on analysis leads perfectly into the next big distinction Graham makes. Investing versus speculation.
Yeah, and this is maybe even more important today with all the noise out there. Graham was very clear.
So investing is...
Investing is a long-term strategy. You buy stocks, funds, bonds, whatever, aiming for steady, consistent returns over years, even decades, building wealth slowly.
And it's always based on that fundamental analysis we just talked about.
Always. Looking at the income statement, balance sheet, cash flow, comparing the company to its peers, revenue, earnings, margins. And when you hold for the long term, compounding does its magic. Plus, the source notes, that short-term volatility tends to smooth out over time.
Okay, so that's investing. What about speculation?
Total opposite. It's a short-term game, aiming for quick profits, trying to time the market.
And it's based on...
Market trends, price charts, news headlines, rumors, not fundamental analysis. That's the key difference the source highlights.
So zero digging into the actual business health?
Pretty much. It's very high risk, and frankly, most people lose money doing it.
Let's take a company like Reliance Industries. Huge, diverse business.
Right. An investor, following Graham, analyzes their energy, retail, telecom businesses, looks at the long-term picture, and buys to hold for years.
Trusting the underlying value.
Exactly. A speculator. They might hear a rumor, see the price jump by hoping to flip it in days or weeks. They don't care about the intrinsic value.
There's a specific quote from Graham in the source, right? His definition.
Yeah, it's powerful. An investment operation is one which, upon thorough analysis, promises safety of principal and adequate return. Operations not meeting this recommendation are speculative.
Wow, that's a pretty clear test. Safety or principal and adequate return based on analysis.
If it doesn't meet that, it's speculation. And the source strongly recommends focusing on investing, not speculating, for consistent success.
Makes sense. Okay, let's shift gears slightly. The third lesson tackles something we all face: information overload.
Oh yeah, Graham wrote about it a century ago, and it's exponentially worse now, isn't it?
Totally. More data, more news, more opinions. It's paralyzing sometimes.
Right. And the source highlights a sentence that apparently changed the mindset for many readers. Depth of your analysis should depend on invested amount.
Okay. Depth depends on the amount. How does that work?
Well, think about it. Imagine you're starting out. Maybe you have, say, 10,000 rupees to invest.
Okay.
And your friend, maybe they're further along, has 10 crore rupees.
Big difference.
Huge. Now, you could spend months doing incredibly deep analysis on one stock, and maybe you hit a home run, 100% return.
Nice. That's 10,000 rupees profit on my 10,000 investment.
Great. But your friend with 10 crore, they might do, solid but less exhaustive analysis on a few established companies and aim for a more modest 10% return.
Okay, 10% on 10 crore is 1 crore profit.
Exactly. So the point the source makes, especially for people starting with less capital, maybe in their 20s,
Yeah.
your primary focus probably shouldn't be becoming the world's greatest stock analyst just yet. It should be on earning more money to invest.
Ah, okay. And keep the investing part relatively simple initially.
Relatively simple, yes, but still analytical.
Yeah.
Which brings us to quantitative versus qualitative analysis.
But quantitative is the numbers stuff.
Yeah, the hard data. Company size, earnings, dividends, assets, liabilities, operating stats.
Yeah.
Stuff you pull from the financials.
Qualitative.
That's the softer side. Assessing management quality, customer loyalty, the competitive environment, tech changes, things that are harder to put a precise number on.
Okay. So where did Graham lean?
His view, which the source echoes, was to focus more on the quantitative, especially when you're starting or don't have infinite time.
Why is that?
The logic is, if the numbers are consistently strong, earnings growing, margins healthy, beating competitors quantitatively, that often implies the qualitative factors are good too. Strong numbers usually mean good management, happy customers, a decent competitive spot.
So the quantitative reflects the qualitative in a way.
Often, yes. Focusing on the measurable financial health gives you a solid foundation without getting lost in, endless subjective assessments.
Okay, that makes a lot of sense.
Yeah.
So we've got the need for fundamental analysis, the investing versus speculation divide, focusing on the quantitative. What about actual strategies? The source mentions a few value-based ones.
It does. 4 main types stemming from these ideas. First, growth investing.
Investing in companies expected to grow much faster than the market.
Right. But the source includes a big caution from Graham here. It's easy to get swept up and overpay for that expected growth.
Which increases your risks significantly.
Hugely. Maybe an exception for truly groundbreaking young companies, but even then, you need rigorous analysis. Don't just buy the hype.
Okay. Second strategy.
Contrarian investing. Basically, going against the herd.
Buy when others are panicking, sell when they're euphoric.
That's the idea. Think Warren Buffett. Be fearful when others are greedy.
And greedy when others are fearful. Classic contrarian. Third.
Defensive investing. This is about stability. Focusing on low volatility stocks or sectors.
Like consumer staples, things people buy no matter what.
Exactly. FMCG, fast-moving consumer goods, toothpaste, soap, basic foods. People buy them in recessions and booms.
So better for stable returns, maybe less growth. Good for people near retirement.
Generally, yes. More about capital preservation and steady income.
And the fourth one.
Asset allocation. This is broader. It's about diversifying across different types of assets.
Stocks, bonds, real estate, that kind of thing.
Yeah. The classic, don't put all your eggs in one basket.
Yeah.
Spreading risk, aiming for smoother overall returns.
The source mentions that 100 minus age rule of thumb for stock allocation.
It does, as a very basic starting point. Like if you're 30, maybe 70% in stocks.
But it really depends on your own goals.
Oh, absolutely. Your timeline, your risk tolerance, it has to be personalized.
Okay, so all these strategies connect back to Graham's core ideas, Which leads us to the final, and maybe the most famous one, margin of safety.
Ah, yes, this is absolutely central to Graham's philosophy. It's his ultimate risk management tool.
So what is it, simply put?
It's the difference between what you calculate a company's intrinsic value to be and the price you actually pay for its stock in the market.
Okay, so if I figure a stock is truly worth 100 rupees a share,
Uh-huh.
and it's currently trading at 80 rupees.
That 20 rupees difference is your margin of safety,
Mm.
or 20%.
Mm-hmm.
It's your buffer.
And why is that buffer so incredibly important?
Because, let's be honest, your analysis might be wrong. Or the market could do something crazy and unexpected.
Yeah.
The future is uncertain.
Right.
The margin of safety protects you. It's your cushion against errors, against bad luck, against volatility. It reduces your downside risk.
And increases your upside potential if you're right about the value eventually.
Precisely. Think about solid blue chip companies, great businesses.
Yeah.
But sometimes, due to a recession or a market panic, their stock price can fall way below their actual worth, even if the business itself is fine.
That's when the margin of safety appears.
Exactly. If you've done your homework, know the intrinsic value, and the price drops significantly below it, you can buy at a discount with that safety net.
The Tata Motors example in the source really drives this home, doesn't it?
It's a dramatic one. The source uses an assumed intrinsic value of, say, 400 rupees per share for the example.
Okay. And before COVID, the price was actually higher, like 484.
Right. So no margin of safety there based on that value.
Yeah.
But during the peak COVID panic,
The price collapsed.
down to around 65 rupees per share.
Wow. So the margin of safety then was huge.
Enormous. Using that 400 rupee value, 400 minus 65,
Yeah.
divided by 400. That's like an 83.75% margin of safety.
Incredible.
And the source highlights the potential result. If you'd invested, say, 1 lakh rupees at 65 rupee share,
Yeah.
it could have grown to over 7.46 lakh rupees in 3 years, a massive 644% return.
All because you bought with that huge discount, that margin of safety?
Exactly. It protected you from the panic and
Yeah.
positioned you for incredible gains when reality set back in. It's not about timing the bottom perfectly. It's about buying cheap enough to be safe.
Okay, fantastic. Let's quickly recap the big lessons from this deep dive into the summary of security analysis.
Sure. We hit on 5 key things, really.
First, the absolute necessity of fundamental analysis. You got to do the homework.
Investing blindly. Second, understanding that crucial difference between investing long-term, analysis-based, and speculating short-term, risky, often analysis-free.
Right. Third, the idea that how deep your analysis goes can depend on how much you're investing, and Graham's emphasis on quantitative data.
The hard numbers. Fourth, we touched on those different value-based strategies.
Mm-hmm.
Growth, contrarian, defensive, and asset allocation. Different flavors, same core principles.
And finally, the big one, the margin of safety. Buying with a buffer between price and intrinsic value.
Your ultimate protection against mistakes and market madness.
These principles, even though they're decades old, feel incredibly relevant today, don't they? They offer a framework.
A timeless framework, yeah, for making smarter decisions, for navigating all the complexity and noise in the market.
It's really about giving you, the listener, a way to cut through the clutter and focus on what actually matters, the value of the business.
Which leads us to maybe a final thought for you to mull over.
Yeah.
In this world where we're just drowning in information, nonstop news, constant distractions, how can you personally apply Graham's discipline? How can you focus on that rigorous analysis and demand that margin of safety?
To ensure you're truly investing with confidence and not just getting caught up in the speculative frenzy.
Exactly. Something to think about.